Valuation session. Am I still recording? Yep. So for anyone that's been through these before with me, it's very similar to the previous ones. For anyone that wants to watch those previous ones, they're on the website again, whitetundra.ca. On the top, you go under events and archived seminars. I think I've covered about 15 or 20 companies so far. For anyone that wants to follow along with this Excel that I have open, it's also on the website on the home page. You go to the bottom and there's a section for files, and it's the first file on there, Excel template. I will also be using some of the company presentations and Q3 results and such, which I send out on the mailing list. If you want to be on the mailing list for future iterations, just shoot me a message or a DM. I can get you on there. Just helps get everything streamlined a bit more. But yeah, we'll get started here, and I'll explain kind of why I do these. So the way that I run these is there's 57 companies now that I'm tracking in the Canadian oil and gas space. Every time the results come out, any quarterly results, I will run these numbers based on the Q4 or the Q3 or the Q2 results. I'll find the companies that really speak to me from a cash flow perspective. There is a changing mindset in Canadian oil and gas and America in a way that people are looking for returns to shareholders. So dividends, share buybacks, and debt deleveraging being the big three, special dividends as part of that. And you want to look at how can a company give back money to shareholders? It's free cash flow. So I've made free cash flow my priority more than the net asset values and some of the other metrics that we have out there. And I basically find my top 5 to 10 companies that screen well on free cash flow. And then based on that, I will then do a deeper dive on these companies, look at the management, look at the stability of the dividend, look at the operational results. Sometimes I'll go well by well and look at exactly how the recent wells are producing and the assets they have, the land they have, any commitments they have, the debt ratios, etc. And I find my top, 3, 4, and then I'll invest in those. And again, this is not investment advice. You have to look at your own risk tolerance, your own portfolio management strategy. There are companies that I invest in that don't screen as well on cash flow, but they have some sort of catalyst coming. They have made some recent acquisitions, which have done really well, etc. And your own portfolio also needs to be, depending on your own, how comfortable you are with investing in oil, what your overall portfolio is, how much of it is in energy, etc. So this is just me sharing my tool. This Excel sheet, like I said, is available online for anyone to use. It's pretty flexible if you want to use it a different way. And I've kind of gotten delayed with some other projects, but I want to have some of this stuff online soon, where I share active live metrics of all these 57 companies on a day-by-day basis. It will be a self-updating spreadsheet. So that's coming. It just keeps getting delayed, but it is coming, which will help people kind of narrow down the companies a little bit easier, in my opinion. But it's just a tool that's out there. It's not my investment advice, so please don't take it as such. So again, anyone that wants to follow along, if you have the Excel open, it's the exact Excel that's on the website. I just have the three companies pre-done, so I can share those kind of as I go. So we'll get started here. And again, for anyone on Twitter as well that wants to join in or ask questions, please join the Zoom call. The link is again on the website at the bottom under events, and the Zoom link is there. Cool. So the first one we'll get started with is Whitecap Resources. So I got a lot of requests on Whitecap. It was one I've already covered 2 times, but I think it's important to go through it again, especially with the amount of requests I got and that the results are coming out this following week. So it's a really great chance to go through a company that, I think has some of the best management in the industry, has some great things going for it. they've done some acquisitions that screen really well. So we'll get started here. So the top box is just the company name. So Whitecap. We're looking for their latest production. So what do I have? So we go to their, what I try to find is the latest MD&A. So the Q3 MD&A, which is the management discussion and analysis file, which usually has everything you need. So we have Q3 production. You always want to take the 3 months ended number, the latest 3 months of data. So 115,935. We'll put that in there. You want the liquids percentage. So you would add your oil and NGLs and divide it by the total to get your liquids percentage. So add all the liquids and divide it by your total production. And I believe it was 75% for Whitecap. So we'll take the crude oil, which for Whitecap is mostly light oil. You can see the breakdown based on their assets and based on, some companies will break it down for you. So we throw the light oil production in there. We throw NGLs 10,279 in there. We get this. We need the number of shares outstanding. So I would look for shares outstanding. Again, Q3 end of period shares outstanding, 632 million. I'm going to put that in there. The share price. So we want the current share price for Whitecap, which is 913. So I'm going to put that in there. The next thing we need is the current debt. So we need the current net debt, which is, again, it's all usually in the same table what you're looking for. So is $1.3 billion. So I'm going to put that in there. Everything in this sheet, when you're filling this out, make sure to look at the units so that everything is working properly. And the description helps you a little bit if there's some questions. So once we put these in, we get some numbers that the spreadsheet fills out for us. So market cap. Market cap is the value of all the company's shares combined. So 5.7 billion. Enterprise value is the total value of the company. So if someone wants to buy Whitecap today, the entire company, that's what it's worth. The debt to EV ratio tells you of the company value, how much of it is debt. So why is that important? Because the more debt that a company has as a value of the entire company, the more of a risky play you can call it, in that if the oil price drops, you have more risk of bankruptcy, you have more risk of refinance or restructurings and such. But if the crude oil price is going up, you get more financial leverage. So depending on your look on the macro, you might be more attracted to certain companies depending on their debt to EV ratio. And again, the lower the ratio, the more stable the company is on the upside and the downside. Debt capacity, this is something it's optional. I don't usually put it in unless the debt to EV ratio is really high, because if the ratio is high, I want to make sure the company is not at risk of bankruptcy. So I will try and find out how much capacity does the company have, how much of their line of credit are they maxed out on, which becomes pretty important at that time. The annual dividend, so I believe for Whitecap is 27 cents a year. So I'm going to put that in there and I'll just verify that. Yeah, so under their corporate presentation, it tells you dividend per share annual 27 cents. So because they have 632 million shares outstanding, that's about $170 million a year that goes out for debt. The next two things we need are the adjusted funds flow and the free cash flow. What do they mean? So adjusted funds flow is money that the company makes after all their expenses. So tax, interest, operating cost, salaries for everyone in the office, the box of pens they bought for the meeting room, etc. That's the adjusted funds flow. Free cash flow is you take adjusted funds flow and you subtract capital cost. So drilling, completions, equipment cost, that's new capital. So you take adjusted funds flow minus capital equals your free cash flow. And free cash flow is after every single expense, including keeping production flat or growing production, how much money did the company make? And this is the company, this is the money that the company can use to pay for share buybacks, pay dividends, pay off debt, etc. So that's the number that's really important. So last quarter's adjusted funds flow, it'll probably be in the MD&A right here. Funds flow, 294 million. So I'm going to put that in there. Free cash flow. It's also known as free funds flow right here. 159 million. So I'm going to throw that in there. So that's how much the money Whitecap made in Q3 of 2021. Okay. However, oil producers do a thing called hedging, which is they enter into contracts that they will sell their oil at a certain price in the future. This hedging can be good or bad. They can make money or lose money. But we need to take the impact of hedging out to understand the true free cash flow generation power of the company, because hedges are short term. They don't last forever. It's specific to the quarter. So we must take the impact of the hedging out. And that's usually known as realized hedging losses, or it's known as derivatives losses. So 3 months ended September 30th. We're looking for the realized gain or loss, and it's $73 million. You always want to look at realized, because the unrealized is the future value, which was not affected in this quarter. You want to look at the realized gain on commodity contracts. So 73 million, because it was a loss, it goes in as a negative. There's a question here on, can you change hedges? You can't change hedges unless you pay off the hedge. So you're basically entering into new hedge, but you're having to pay off the current hedge or the current loss you're in. Or you can add more hedges, which then changes the average price of these of the hedges you already have. Whitecap did buy back shares, but I'm just going to leave it empty because they ended up using the shares for more acquisitions, so it wasn't really a buyback. Okay, so the company unhedged would have made $232 million at Q3. Okay, but at what pricing? Because oil price changes, and if the oil price goes up or down, the company's free cash flow generation goes up or down. So we need to find out at what price did the company make $232 million. And that's known as the benchmark pricing. So I just control F and search for the things I'm looking for. So the average benchmark pricing for Q3 on WTI was 70.56. So I'm going to put that in there. And make sure to watch the units. Again, the spreadsheet is built a certain way, so you have to agree with some of the units that are going on. They don't sell heavy oil, so I'm not worried about the last quarter WCS pricing. They do sell NGL, so I'm going to go, the NGL, they got 45.64 Canadian dollars a barrel. So I'm going to convert that to US, and we come up with, I believe, where am I here? 45.64. It ended up being 35.82. So I'm going to put that in there as the NGL price that they got for Q3. Okay, so we know how much money they made at what Q3 pricing. Now we need to know, what is the future pricing of oil looking like? So over the next 12 months, what is the average WTI pricing? And there's two ways to get this. I will give you RBC. If you go to rbcrichardson.com, it tells you NYMEX crude oil 12-month strip is 84.76. So if you're looking to sell oil for the next 12 months, that is the average price you will receive. So why is that different from the current price, you might be asking? And the reason for that is that oil sells on monthly contracts. So the price for March 2022 is this. April is a little bit lower, and so on and so forth. This website, cmegroup.com, goes all the way till 2033 or 35. You can get pricing well into the future. And the way that RBC has calculated this price is they've added the next 12 months and divided by 12. So they've taken the next 12, divide by 12, and lo and behold, you get the exact same pricing that RBC has of 84.76. But I'm just stressing this because it's important to know where the number comes from and what it means, rather than just pulling some data point from somewhere. So this is the average strip pricing. You take the 12 months, the next 12 months, you divide by 12, and then once you know how to do that, you can just pull it off this RBC website. So 84.76 is the strip pricing for WTI. For NGLs, RBC gives us some information. It's roughly 46.25. That is on American hubs. It's not necessarily correlated to the Canadian hubs, but we'll use that number for now because it's just easily accessible. So I'm going to put that in there, 46.25. And okay, now for the gas production. Whitecap is a Canadian oil company. They don't have too much gas, but the gas that they do have, we're just going to assume they sell it on the Canadian hubs because it's not a huge part of their revenue stream. We want to get through these calculations quick because if there's 57 companies, or you might be using this for mining companies or other American companies, there could be hundreds of companies you have to go through. We're not worried about the little details. It's more about the main point. Is the company generating cash flow? So I'm going to throw 100% in there for AECO gas, and we'll look at the benchmark pricing again. So for gas, it was 360 for Q3. So I'm going to put that in there. The strip pricing for AECO gas, which is just like we did for oil, we can do the same for gas. I don't have it open here. So the website is called gasalberta.com. And all these links that I'm talking about are also on the website. If you go under dashboards, links, you will find all these links that I'm referencing here, and you can kind of go through them. But it gives you the next, where is it? The next 12 months of pricing. Again, you take the next 12 months, you divide by 12, and I think you end up at roughly 4.2 Canadian dollars per gigajoule. So put that in there and you're done. If the company had other kinds of gas streams and it's mostly a gas company, you want to put in NYMEX or other gas in there. But for Whitecap, it's not really important. And that's basically all you need, about 10-15 minutes and you're done. So the spreadsheet then spits out a few tables here for you. The first table is a free cash flow table. So it's taken the free cash flow that they made in Q3, it's multiplied it by 4 to annualize for it, and then you can get the same number depending on where you think oil price is going in the next 12 months, including strip, which we calculated is the actual price for the next 12 months. And you get a bunch of numbers here, but annualized last quarter's free cash flow, it's just that. It's your last quarter's free cash flow annualized for the change in gas price at a certain oil price. And you get a free cash flow yield. The free cash flow yield tells you that of the company's entire value, their enterprise value, how much of that are they generating in free cash flow? So at strip pricing, which is 85 WTI roughly and 4.2 gas, Whitecap generates roughly 21.5% of its entire value in free cash flow. Okay, that means that Whitecap can pay off all its operating costs, it can pay off its salaries, etc. It can spend money on drilling, completions, etc. to keep production flat, and they generate about 21% margin, you can say, or free cash flow yield on top of that. So why is that important? Because this 21.5% is what they can use to pay off debt, to pay you a dividend, to buy back shares, to do acquisitions, to do special dividends. That's the money they have left in 1 year. I usually put, like, I'm looking for a company, if I'm investing in oil and gas, I'm looking for a company with a 12.5% yield. So why is that? A 12.5% yield gives me a 5 to 6% dividend. It lets the company buy back 3 to 4% of shares, and I still have 2 to 3% left over for little acquisitions, for paying off debt, etc. We know Whitecap's debt to EV, is very low, so they're not in any hurry that they have to pay back debt. So a 12.5% gets me, again, a 5 to 6% dividend, 3 to 4% share buyback, and then a little bit left over for extra acquisitions and dividend increases and such. And what I'm saying at 12.5% is I want the company to generate its entire EV in free cash flow in 8 years. Because if you take 12.5% per year is what you're getting, you multiply that by 8, you get 100% of the company's value in 8 years. And if we reverse that way of thinking, we're valuing the company at free cash flow times 8. The multiple is an 8 multiple. It's just what I use for stable companies like Whitecap. If it's a riskier play, a smaller company, you can use a 6 multiple. And again, if you want to do that, you just go into this box here and you can change the formula to whatever multiple you want to use. But I like to use 8 because it's a good multiple. I think companies can get back there. There's companies already back there. Some of the more higher valued companies in the oil and gas space in Canada especially are already at 8 times free cash flow. So we take our annualized free cash flow, we multiply it by 8 to get our 8 multiple, and then you subtract the debt because this is a total value of the company. If we want to know the value of the shares only, we need to subtract the debt. So you subtract the debt, that's what the equity is valued, and then you divide it by the number of shares to get a fair share price is what I call it. So at $80 WTI, at an 8 times free cash flow multiple, this is my fair share price for Whitecap. So now a couple points I should make. One, this is not an absolute valuation tool. I'm not telling you that the share price is going to be $14.75 in a month or in 6 months or in a year. What I'm telling you is the upside that remains. So if you believe in $80 oil for the next year and Whitecap's current share price is $9.13, you have about a 50%, 55% upside if we do get to this multiple, okay? Once I've run this on all 57 companies, I will find the ones that have the highest upside. So there's companies I can tell you today that at 80 WTI have 50%, have 20%, have 80%. You pick your top 5, your top 10, how many ever you have time to do a deeper valuation on, and then you have your kind of short list of what you're looking at. It's a relative valuation tool. You get the number, you get the percent upside, and you compare it across the industry. And there's a really good comment here that, when people say, oh, Whitecap is being valued as if WTI was $70. Yes, because at $70, the fair share price at this multiple is roughly what the price is. So Whitecap currently is being valued at somewhere around a 70 WTI. So when people share those charts, you'll see them all over the place that, this company is being valued as if oil was at 45 or at 65. That's what they're referring to. The other thing here that I want to make a point about is at somewhere between $50 and $60 a barrel, the value of Whitecap goes into the negatives. So why is that important? Because what this is telling you is below $50 a barrel, somewhere, $51 a barrel-ish, Whitecap's shares are basically worthless. It's the debt is the value of the company. So below that is when you would kind of see these share prices really start to collapse. We saw that in the COVID, when the COVID spike, or not spike, but the drawdown first happened. Because the oil price fell below some of these numbers, the equities became worthless according to the robots and the algorithms. And so they started dumping these equities, 30, 40% in a day sometimes. The doomsdays for us oil investors that we had. So keep those things in mind. Keep in mind where the company goes negative. Keep in mind where they're valuing at, and keep in mind what your upside is. Those are kind of the three things that the spreadsheet tells you. Now, this table also gives you another number, which is for a lot of followers of Eric Nuttall, he uses this for his charts. When he says, this company can privatize and pay off all its debt in so many years, this is what he's using. If it's 25% free cash flow yield per year, that means Whitecap can privatize and pay off all its debt in roughly 4 years, just over 4 years, right? 24.5% a year. How many years does it take to add up to 100? That's basically what his charts are telling you. And you can compare what you get with his charts. It will usually be pretty accurate with a little bit of safety net, depending on what numbers you're using, and kind of the timing of them. So that's the first method, free cash flow times 8. There's another method, adjusted funds flow times 4. If you want to be more on the conservative side, you don't really know how much capital the company is spending. You want to know how much money does the company make before they spend capital. You can put a 4 multiple on adjusted funds flow. And again, I like to use 4 across the board. I don't take it lower for more risky companies, because 4 is just a very safe multiple to use. It's very conservative already. And, I've got the question as to which one to use. I will tell you this, for oil sands companies, free cash flow is the one to use, because they've spent a lot of their money already, and free cash flow is what really matters. If it's a very heavy growth company, someone that's spending a lot of capital, you want to use adjusted funds flow. For a lot of gas companies, I would lean towards adjusted funds flow. I still use free cash flow for everything for my own personal investment decisions, but you can use adjusted funds flow as well and compare companies relatively. That way you don't have to think about the capital efficiencies and how much money the company's spending. But free cash flow takes everything into account. It takes into account decline rates, asset quality. It takes into account how much money the company's spending to keep production flat. So it's more of an all-around picture at the end of the day. How much money can I actually get back in dividends, share buybacks, and deleveraging? So that's my kind of explanation for that. Are there any questions? Anyone following along who's had any problems or anything? Nope. Okay. So that's all fine and dandy, but these two tables, remember, we took hedging out of the equation to get our true unhedged free cash flow. But that's not the reality. Some of these companies are hedged for the next 12 months, 24 months, etc. So we need to bring hedging back into the equation. And we have Q4 hedging, and then we have the 2022 hedging is how I built this sheet. If the company has already reported Q4 and you're using Q4 numbers, leave these blank, leave the Q4 blank, and only put 2022 information in there. and the information is available usually in the corporate presentation, you'll find this. So I have an older corporate presentation of Whitecaps. You have your hedging here. Collars and swaps are both in here. And the way you calculate the hedging is you would take your volume. So this is October to December is this volume, and this is the maximum price you're getting. You know, you need to have a little bit of background on hedging. I will say for right now, just use the highest number because that's what they're getting. So they have this volume at this price and they have this volume at this price for October to December, which is the next 3 months. So you just do a averaging calculation. You multiply this volume by this price, and then you add this volume by this price, and you divide it by the total volume, which would be 21,250 plus 5,500, and you get this many barrels at this price is the average average hedging. And you do the same for the whole next year. I'm not going to go through it. I'll just show you what it comes up with. You get this many barrels at this pricing. Again, in Canadian dollars, make sure to look at the units. And then the same for gas. Basically, I've done the exact same calculation. I've taken the, where is it here? The gas hedges. So October, they have this hedging. November, they have this hedging. And you just do simple averaging and you get the hedge, the actual hedge books as to what they're projecting. So I'll leave it at that. Whitecap's newest presentation actually is nice because it has the hedging in a, where is it? Yeah, it has the latest hedging, but you can't get the Q4 hedging. So you might have to go back to an older version of the presentation if you're running this. So again, I put all these numbers in. If there's any problems, feel free to contact me, but that's literally the hedging, how you calculate. It's just simple averaging. And we get how much money they're going to lose in Q4 for the hedging, on the oil and the gas, and the 2022 hedging impact at various WTI pricings, and you get our hedge adjusted free cash flow. Okay, so this was unhedged. Now we have actually adjusted this for the hedging, and we get, again, different fair share prices. And I would do the same thing. I would run them all into the spreadsheet. I would find the top 5 or 10 and then decide to do a deeper dive on those. So let's compare the numbers that we have to what management came up with, because management in the latest Whitecap presentation gives us some numbers to work with. Here we go. So at 80 WTI, and free cash flow is always pre-dividend. So you want to add this dividend that they're putting in there into it. So at 80 WTI, they're generating roughly 1,100 plus 170. So about 1,270 of funds flow. Our spreadsheet is telling us at 80, it's about 1,136. So a little bit lower than what management is telling us. So why is that? That's because the company is growing production in Q4. So there's a little bit of a skew factor there that, again, we will adjust for here. You know, at 90, it's 1,483. Management is telling us it's about 1,500. So that one's actually pretty close at $90 oil. Okay, I'll deal with these questions now while I have them. Does Whitecap get any value for being net carbon negative? I've got a lot of messages saying that the government is coming up with these payback schemes, that Whitecap's going to make all this money because they're net carbon negative. So 2 points to that. One, I don't know when the scheme is coming out. And 2, no one knows what the actual value of it is. I don't think that the Canadian government is going to start throwing millions, like hundreds of millions of dollars, where it really affects Whitecap's enterprise value or their reasoning for investing in these companies. But so when I'm looking at this net carbon capture thing, I don't take that into account because I don't think it's material enough. Some people do think it's important. So, you know, I'm actually interested to hear, how are you valuing that? How much value are you giving that, and why? So feel free to reach out to me if you are taking that into account. There's a question here on, outside of the financials, which Whitecap assets do you like the most? Okay. The Weyburn CO2 field, I've worked there in the past. That's a really incredible field. It's about 30,000 barrels a day, solid decline rate. You know, you get really good netbacks there, and it's just a solid all-around field. The other one I like is the Carr asset, which is not actually their asset. They're doing some JV, joint ventures, with Hammerhead on that, and I think I've discovered something in those fields that is very interesting. There's some natural fractures there, which I'll talk about when I get to Spartan Delta, because they're in the same area. So I like their exposure there and being able to build on that area. Other than that, you know, the rest of the fields are pretty consistent. There's nothing that really stands out to me. The Wapiti Cardium, I like that field as well. I used to work there for a different company. It's pretty good production in the Cardium, but again, none of their other fields are really, you know, big sexy fields. They just produce how they produce, and they make a bunch of money. So there's no outside catalyst, I guess, in a way. I'm gonna get, okay. How do I adjust for the oil field service cost rise? So that's in the capital cost that you put in. So I'll go through here in the spreadsheet where you put that in. Do I believe companies are being forced to hedge? Some companies were, who had bank lines of credit, and those that were with the BDC, the Business Development Bank of Canada, I believe, were being forced, but I don't think that's any longer the case. So I guess, I hope that answers the question. I don't think many are going to get forced in the future because they're deleveraging, they're getting rid of these bank debt lines, and going forward, cleaner balance sheets. Okay, so we have all this. Now, Whitecap did some acquisitions in Q4. They had consolidating acquisitions of about $340 million. Because it was later in the year, I'm gonna leave it for Q4. If the company does an acquisition that's right away effective in Q4, I would put them in here. With these acquisitions, the dates are not really clear, so I'm just going to leave it for now and put it in as a 2022 acquisition instead of that. Those with divvies like to hedge a bit. So yeah, any companies with dividend will hedge a little bit, you bet. So again, if you want to find out the Q4 free cash flow projection for Whitecap, I would put these numbers in, and it will spit out what the spreadsheet thinks their Q4 will be. Then you compare it to their actual Q4 and may have to adjust a little bit depending on how far off the numbers end up. Yeah, I'm going to leave it blank for now. It puts in your Q4 dividend and such. You know, I'm going to ignore the Q4 for now because it's just not important to the point we're trying to make. They have no preferred shares. So we have a 2021 ending enterprise value. That's probably going to be a little bit lower than this because they'll pay back debt in Q4. Again, I'm going to leave it for now and go straight to 2022. So Whitecap's production was 116,000 in Q3. In 2022, they're saying that their production is going to be 2022, they're saying 131,000. So it's up 15,000 BOEs a day at roughly the same liquids split. So how much are they growing? They're growing 131 minus 116, which would be the 15,000 BOEs a day. what's the net back on the growth? I put 40 in there, but how did I calculate this net back? And this is where it can get a little tricky with companies that do acquisitions. You have to adjust accordingly. You can just throw a random number in there, but if it's a significant enough acquisition, you really want to take things into account. So we'll go to the acquisitions. It cost them 342 million, and the operating income multiple was 2.6 times. So what does that mean? That means on a net back, operating net back basis, they're going to generate $342 million on the 9,000 BOEs of production in 2.6 years. Okay, so we take the 342 million and we divide that by 2.6. That gives us their operating netback per year. Then we divide that by the number of barrels. That gives us the operating netback per barrel per year. And then we divide that by the number of days in a year. That gives us the operating netback per barrel per day, which is 40.10, which is the number I had put in there. Every acquisition, they will give you some sort of multiple. They will give you an operating income multiple or a adjusted funds flow multiple, which you can then backtrack and find the net back of. I don't know why they don't just give you this number. I mean, it would make things a lot easier, but more work for us, so we can find better opportunities that the people who aren't putting in the work are ignoring. There's a question here about a small cap Canadian company. So yeah, I would use a 6x, yeah, on a small cap company. A 6x, if it's a small cap that I know and trust, I would still go with the 8x. If it's a company that I know is not going to go bankrupt, has a pretty good debt profile, I know the management, etc., I would still put an 8x. But for the sake of ease, yeah, you can lower the multiple as you go. So I hope that calculation makes sense on how I calculated the net back on the acquisition. And if not, feel free to reach out to me. I can go through it again, or on a different acquisition, etc. But anyway, so 15,000 barrels at 40. That gives us our 2022 adjusted funds flow at strip, which, remember, again, is 85 oil, 4.2 gas. That's what we put in here, 84.76 oil. 4.2 gas. Then we look at the 2022 capital program. How much money are they spending on capital in 2022? And they give that to you. It's 520 million is what they're spending. Pretty simple. So we put 520 in there. And this is where, if you think inflation is going to run rampant, feel free to put 600 in here. This spreadsheet is fully flexible. It's not that you have to put in a certain number that management gives you or that I give you. You throw whatever you want in there that you think makes sense. If you know that the drilling industry is going to get real tight, you want to put 700 in there, you put 700 in there. It's fully open. So, we get the hedging impact in there for oil and gas, and we have our 2022 projected FCF yield at strip pricing. So again, you take this number and you compare it among the 57 companies, you find your top 5 or 10. If you don't want to do all this work, you just go and compare right here. If you want to put the hedging in, you think hedging is important, you put the hedging in, you compare here. If you want to compare it in the future, you want to put a little bit more work in, put in the production growth and XYZ, and you get the number after everything. If you think the company is going to sell some assets, you can put other free cash flow sources in there. It's up to you. But the number I want to look at is this. The 2022 projected FCF at strip is 1467 at 85 WTI. And let's compare it to management's number, 1213 plus 170, about 1380. We're getting 1467. Why is that? Because management might have a more conservative number for their NGLs. they might have a more conservative number for their AECO gas, and they're using a certain number, but it gives you confidence that we're pretty damn close. Like we're within 4%, 4 to 5% of what they're telling you, and then you can basically play around with numbers. If you think their wells are going to blow it out of the park, they're going to add 20,000 barrels, you put that in there, and the number adjusts accordingly, right? So it's very flexible. If you know certain information about the company, if you have a bead on something, feel free to adjust accordingly. And then you can do the same for 2023, and it gives you the 2023 projected FCF. So if your investment time frame is a little bit longer, you don't want these hedges to have such a huge impact on your comparison, your relative valuation. You can go to 2023 and onwards and onwards. So the recording, so the recording will be uploaded by tonight, maybe tomorrow morning, on YouTube, and available for view, fully free. Given management's intention to return cash to shareholders, what is your preferred method? I love share buybacks. The share buybacks help me because I can have increased share price appreciation. I'm not having to pay tax on the dividends and then decide again what to do with the cash, most of which I'm funneling back into the same equities anyway. And debt deleveraging is also good, but I think there's a point at which you don't really need to go below too much on the debt. So share buybacks are my favorite for sure. By far, special dividends, I hate them because, like I said, I'm paying tax on it, and then I'm jamming them back into the same company anyway. So what's the point? I really didn't gain anything, and it took money out of the share price. Just my opinion. I don't want this to be taken as investment advice. And because I buy options as well, I like companies that don't have dividends or have low dividends because it's better for the option pricing and the upside that these options hold. So that's that. I mean, that was around 40 minutes, and we got through one company. The next one will take 20 minutes because we already have a bunch of the information, like the strip pricing and whatnot. We don't need to redo them. Any questions on Whitecap? Any other questions? Anyone wants to make any comments on it? No? Cool. Okay. Right on. Thanks for the answer. Yep. And Ark as well. Yeah. So all the other companies are on my website on the YouTube links. I've covered a bunch of gas companies, a bunch of small caps, a bunch of mid caps, some companies I own. The last one was I think really good. I shared some well results from Surge and Baytex, and I forget what the third company, Pine Cliff Energy. I shared some actual well results, so I think people will find that interesting. How much should we pay attention to bond credit rating? I've never even looked at that. I did in 2020 when some of these bonds were getting whacked, but what does it really mean? I don't think it means anything. Some of these agencies put out numbers that make no sense. So thanks for the question, but yeah, I personally don't look at that. Cool. So we'll move on to Peyto. Peyto is more of a gas company. So I like this because last time I did Pine Cliff and people were wanting to compare other gas companies. So, this is a good one to compare. It's a strictly dry gas company. They've done exceptionally well for their shareholders since they began. One of the strongest managements again. I think, betting on the Gray family, you can't bet against them. So I'm looking good. So we'll get started. Same thing. Peyto, we go to their Q3 MD&A. Barrels of oil equivalent was about 89,998. So we're 2 barrels shy of the 90,000 mark. The liquids is about 12.5%. Again, take all your liquids, divide that by your total BOEs, you get your liquids percentage. They break it down for you here. Oil and NGLs. So We'll put light oil and NGLs. Okay, shares outstanding. So Q3 weighted average shares outstanding, about 166 million. We put that in there. Share price, easily found, 1001. We throw that in there. Current debt, which is net debt. So we have net debt as of September 30th is about 1.131. So there. So a higher debt to EV ratio than Whitecap. Okay. Again, it's a relative valuation tool. You invest in what you feel comfortable with. It's still not high enough that I'm really worried about their debt capacity. So again, I'm going to leave that blank. Their annual dividend, 60 cents, I believe. Make sure here. So the monthly dividend for March was, yeah, so 5 cents a month, so 60 cents a year is how I would calculate that. So we put that in there. And then again, we're looking for the adjusted funds flow. So adjusted. Sometimes they call it different things, so you really need to, right here. So funds from operations, 105 million. I believe that's what I used. Yep. So funds from operations, adjusted funds flow, very similar things. And we take funds from operations, we subtract the capital expenditures to get the free cash flow. So 105 minus 90, we get 15 as our free cash flow. Dividend. So hedging impact, we need to look at hedging again. So so hedging, they lost 62 on gas and they lost 10 on oil. Realized, again, it needs to be realized hedging losses, right there, realized. So 72 million. So I'm going to throw that in there as negative. No share buybacks. Last quarter pricing. This is going to be the same for every company. So you don't really need to go back and check over and over. The strip pricing is going to be the same number we put in. They don't sell heavy oil, so it's not important. There's a question here on what was the final price target on Whitecap after hedges. So I'll go give that to you quick. It's at strip, it's 14.51 after hedges, but before production growth. So just keep that in mind. NGL pricing. So Peyto actually gives us the NGL pricing, which is nice. Which is their right here. Other natural gas liquids, 37.97 Canadian. So we're going to convert it to USD. We get 29.80. And then the strip. Now, Peyto's NGLs are not quite the same quality as what people are selling at Mount Bellevue, which is my strip pricing that I'm using. So I don't think it's fair to use that number. I'm going to put 35, take $10 off that. Again, the spreadsheet is flexible. You put in what you want. If you know someone working at Mount Bellevue, you have some NGL pricing, etc. You can kind of put whatever you want. Now, the production is important for Peyto because they don't only sell into AECO, and it's complicated with Peyto. So winter 21, they have 53% to Empress, which is basically AECO pricing. They have 36% to Emerson and so forth, and it's a changing kind of blend as it goes forward. I'm going to use the winter numbers for now. So 53% to AECO and 43% or 47% to other. So like 53 there and 47 there. And again, we look at benchmark pricing. What did they get for AECO? They got somewhere between 336 and 340 is the benchmark pricing. That's not what they got. That's the benchmark pricing. So 340, I'm going to put that in there. Other gas price, it's mostly Emerson, you know, about 36% of their sales are to Emerson. So they got 371 US, which is about 450 Canadian. So I'll put that in there. Projected AECO, we did the same for Whitecap. It was about 4.2. Projected Empress, you can guess or you can find out. Some of these other hubs, it's really hard to find information on them. But I'm going to take Henry Hub, 4.5 US. That's about 575 Canadian. I'll put that in there. And you have the numbers again, the exact same as what happened to Whitecap. It's the exact same calculation. You know, Whitecap was at 100 WTI was at 30%. This is at 23%. But if you believe that AECO gas is going to $7, there you go. Now it becomes a higher torque play because it's a gas company, right? So there's more torque to gas than there is to oil. So again, put whatever you want in there. As things change, some companies become higher torque, some become lower free cash flow yields. It's all a moving kind of system. Hedging. So Peyto's hedges are kind of a nightmare to deal with because they got so much hedging at so many different hubs, but the math stays the same. You take the gigajoules at what price, and then you add them all up and you divide them by the total gigajoules of hedging or MMBTU. It doesn't really matter. Gigajoules, MCF, and MMBTU are close enough that for the sake of this exercise, you don't really need to go in and adjust them. Feel free to do it if you want, but I just don't think it's worth the time. So this is what I find. The hedging situation on the oil, hedging on the gas. We see the Q4 impact. We see the 2022 impact. And what you'll notice is that they're actually losing a lot of money in hedging looking into the future. So at $80 oil, it was roughly a 1583 share price. So about 58% from where we are today. But once you put the hedging into account for the next year, it's actually trading at a premium to what the 8 times free cash flow would tell you. Your upside on an 8 times free cash flow multiple is actually negative. So this is why I think it's worth doing the entire spreadsheet. If you just looked at this, I mean, it screens wonderfully against a Whitecap, but once you put the next years of hedging in, it doesn't screen that well. So I'm not gonna say you have to do one way or the other, but the more work you put in, the better investment kind of thesis you come up with. And we're about 10, 15 minutes into Peyto, and that's really all the time you need to spend. I'm not asking people to spend hours and hours. It's a pretty simple spreadsheet. They're not growing production in Q4. They're not growing production in 2022. So basically everything stays the same, 0, 0. And you have a projected free cash flow strip of 10%. Compare that to Whitecap, which was 19%. So at this point, if I was doing this for my own investment decision, Peyto is a company I would not look into further. It would be lower, like way too low on my list. And yeah, I just find my top 5 or 10 and I do a deeper dive, and that's how I invest. So does that make sense on Peyto? Is there any questions specifically? And we can kind of play with the numbers. Like if you think gas is going to, AECO is going to $7 and Henry Hub is going to go to $8, I mean, it does increase the projected free cash flow. But the sad part is they got so many hedges that they just can't take advantage of it like some of the other companies. And that's why I think looking at hedging is very, very important, especially if your time frame for investment is within the 3 to 12 month period. You really need to look at hedging and make sure there's nothing crazy going on there. So yeah, that's it on Peyto. I don't have any well results to add on Peyto. They got pretty decent cardium stuff. It's a pretty decent decline rate. It's nothing special. It's more of a gas high torque play. If they can get out of the hedges, they can definitely have this more of an upside potential, right? Like, let me just go back here. So at 4.1 ACO and 5 NYMEX, we have roughly a 58% upside at $80 WTI. But at $7 ACO and $8 Canadian Henry Hub, unhedged, your upside is almost 300% at $80 WTI. The key point being unhedged and the ACO price going that high, right? But we're not there yet, and the company is not unhedged. But if you're looking into 2023, 2024, you want, these inflection point kind of equities, this could be one you could buy when the hedges are rolling off. You look at buying this because the free cash flow changes a lot at that point. Yeah, Jeff, go ahead. You had a question?
Hey, can you hear me?
Yeah, go ahead. Thank you.
Hey, so that 8x multiple. Sorry, I just dialed in, joined, so I may have missed it. So this is always the thing I struggle with a little bit in coming up with valuation, is that multiple. Where do you get that 8x from?
So yeah, so I talked about this earlier. So the recording will help you a lot, but I'll just summarize it here. I look for a 12.5% yield on the company, which gives me a 5 to 6% dividend. It gives me a 3 to 4% share buyback and an extra couple percent for the company to do acquisitions and debt deleveraging. And so I'm looking for a 12.5% yield, which is roughly 8. If you go 1 over 12.5, you get the 8x multiple. At the same time, you can put in whatever you want in this spreadsheet. And I want to re-say this point. It's a relative valuation tool. So if you use 8x across the board for every company, and you find some companies have more of an upside potential, it doesn't matter what multiple you use, because you're looking for the relative ones that are underpriced at this point, and have the biggest upside. So hopefully that answers your
no, it does. I like that. When I was doing the gear space a few days ago, Josh asked me about that. So I in the past I've used something a little lower, but yeah, that's good to know. I like how you're thinking about it in terms of that 12%. So all right, thanks, man.
Yeah, thanks. And this spreadsheet, again, if you want to use 6, you just go into the calculation here, you adjust the formula and drag it across, and you can use 6. You can use 4, whatever you want. There's a question here: what is debt adjusted free cash flow? So debt adjusted free cash flow takes the interest payment into account, because the theory being that as you pay down debt, the interest goes down, so the free cash flow should go up. For most companies, it really doesn't matter, so I don't really take that into account. I'm sure there's more caveats to what debt adjusted free cash flow is, but it's basically taking the interest portion and the debt portion out of it, assuming it's a debt-free company in a way. How long before the hedges are done? Oh, I hate to break it to you, but Peyto has hedges like up for a while, and significant volumes of them until the end of 2023 kind of and onwards at pretty poor pricing, given that they hedged them before this whole ACO supply demand issue kind of fixed itself, and before the LNG pricing went through the roof in Europe and Asia. So they've unfortunately got some pretty poor hedging into the future. So, and it's hard for a company like Peyto to grow production because their decline rates are like 35, 40%. So not only do they have to go through that, they then have to grow production on top of that, which requires a lot of capital. I just joined. Where do you deal with capital efficiency is the question. So capital efficiency is dealt with by looking at free cash flow, because when you look at free cash flow, it already takes into account the capital required per BOE to keep production flat. So free cash flow is a post capital efficiency, post decline rate, and kind of like after all that is taken into account, post asset quality kind of metric. It's not perfect, but it does adjust for it to a certain extent. Cool. Okay, so Peyto decline rate is estimated at 28%. So yeah, it could be a little bit lower now with some 2021 wells on production and such. They might have a little bit of growth baked in to their 2022 predictions, but I mean, it's all gas. It doesn't add much net backs in terms of a dollar. I mean, let's say they added 10,000 BOEs at gas would be maybe $18 a BOE. You know, it seems to make a big impact here on the projected free cash flow, but I will check that. I don't think that's right. Just adding 10,000, or my BOE netback I'm using is way too high. But yeah, for sure, feel free to put these numbers in, and you might find a gem in there. You know, if Peyto can somehow increase production by 20% and get some sort of you know, huge uptick because it's unhedged production, you could find a gem in there. But for me, I tend to shy away from the gas plays. It's just too much on the macro that I don't know compared to oil, which I think I understand quite a bit better than the gas side. Peyto gets 115% gas premium for its heat content. Yeah, you're right. They get a little bit of extra pricing in there, but you know, the point I'm trying to make is that it really doesn't matter. Even if you use $5 AECO and you use, you know, $6.50 Henry Hub, you know, it's still 12%. It doesn't compete for my dollars unless they can bring on a huge whack of production, but then the dividend becomes unstable. They're paying roughly a 6% dividend, I want to say, or yeah, 6% or so in a dividend. So, you know, I don't want them to spend a whole whack of money on capital anyway. But if you put the work in, you can find the gems. If there's something you know about Peyto, they might do an acquisition for cheap, and they can grow unhedged production. You know, but I don't want to get into that sort of discussion because it's so subjective. It depends on what you know and what you think is going to happen. Great. So that's Peyto. We will get into Spartan Delta if there's no other questions. So Spartan Delta is kind of my newest name that I got into here. CIBC posted that Peyto trades at 40% of their PDP reserves. I do like the reserve net asset values because I think they're going to become more important going forward, especially because a lot of investors in 2010 to 2014 who will come back used to use net asset value instead of free cash flow. However, I don't think net asset value really means anything anymore. For certain companies, yeah, if they're very, very out of whack, yes, but they just look too far into the future for me to take them into full account. Well, that's impressive. PDP of $24, unreal. Yeah, so some companies have huge reserve asset bases, but I don't really take that into account for my free cash flow yields, because for me it's which company is going to give back the money and be out there in the market doing dividends, doing share buybacks. The net asset value doesn't get realized until 5, 7, 10, 20 years down the down the road. So unless you think that asset managers are going to put stock in that and take it into account in a big way, I don't really think it's important. But there are companies like Surge and Obsidian, for example, and even Meg, that I think have these huge asset revisions coming up to their net asset value because they're heavy oil players. It goes from like $7 a barrel or $4 a share to like $20 a share. And those are almost like catalysts that I keep an eye out for. The exact number is not too important to me, but I'd love to talk more about that, Robert, sometime here, and how the rest of the industry trades on PDP at some time here. Okay, so we'll get to Spartan Delta. Again, this is a name that I recently got into. Full disclosure, I was not able to buy the size of position that I wanted in this name. It just ran up about $1 from my initial inlet, and I still would buy it, if I saw a big block in there. But right now, it's about 3% or something of my white Tundra portfolio. 2 or 3%. So Spartan Delta is nice because they've released their Q4, not the actual Q4, but some sort of update, which is basically a Q4. So we're going to use this and go. This is their most recent news release. So this is what you want to look at. We'll use Q4 numbers specifically. So fourth quarter production right here. So Spartan achieved fourth quarter production of 72,428. So we put that in there. It was 38% liquids, which is right there. It tells you oil, percent oil and NGLs. Sometimes a little bit further down, so you might have to look for it. You add crude oil and condensate, you get 13,823. So I'm going to put that in the light oil category. NGLs 13,576. Put that in there. Shares outstanding. Common shares outstanding end of year 153 million. Now, Spartan Delta has about a 10% dilution in their fully diluted share count. A lot of companies are within the 2 to 3%. Spartan Delta is 10%. You might want to use fully diluted share counts. I like to use common share counts because the dilution just gets very, very complicated as calculating what price it's at and whether they're warrants, whether they're options. It's just too much work for a quick and dirty calculation. So I'm going to leave it as a undiluted share count. Stock 818 is where the stock closed at on Friday. Again, we get the market cap. We get the net debt right here, $458 million end of the year. We're going to put that in there. We get there's no dividend. The adjusted funds flow for last quarter was 294. Free funds flow, no, hang on, this is the entire 2021. So we want just Q4. So free funds flow was 21 million for the fourth quarter. So I'll put that in there, 21. And adjusted funds flow, Spartan generated AFF of 137 million in the fourth quarter. So that's what we throw in there. Hedging impact, again, it's the exact same formulas that we're using. Nothing has changed. You're just looking for the same numbers in a different way. Settlements on commodity derivatives. No, that's That's 2022. We want 2021, which is okay. Right here. So 3 months ended December 31st. Settlements on commodity derivative contracts. It's known as hedging. It's known as risk management. It's known as commodity derivatives. It's kind of the same thing, but that's what you're looking for. Settlements, meaning realized. Always look for realized hedging, not unrealized. So 43 million goes in as a negative. No share buybacks, no WCS. NGL pricing, I'm just going to use what we had for Peyto. You can throw in some other numbers in here, but for the sake of ease, I'll put that in there. And then again, for the sake of ease, I'm going to put 100% ACO production. They do some market diversification, I believe, selling into the US, but this just makes things easy. Last quarter pricing, it's going to be the same for every company, I believe, anyway. I'll just verify that. So they don't give us the benchmark, so I'm just going to use what Peyto gave us. Peyto and Whitecap, and then the projected price, again, strip pricing, and we have our yields. So Whitecap at $100 oil was about 30%. Peyto was unhedged, 28. It was around 23. Spartan Delta gives me around 32. 35 actually, in fact, now that we ran the actual numbers. So, this one screened really well for me for a long time, but I was concerned about the well results specifically that I will talk about here later. I have some latest data to share on that. And once I got the latest well results from Petro Ninja, and they were showing up to be incredible, I knew I had to take a position here. And at strip, we're looking for more than a double, about 125% upside here. Even on adjusted funds flow, it screens really well. Where we're seeing really solid forward pricing there. The hedging, for the sake of time, I'm going to just tell you this is what the hedging is. It's in their corporate presentation. If you go to the bottom here, risk management portfolio, they tell you exactly what it is. And then in the appendix, you can go contract by contract. And this is exactly what I've put in here. So screens relatively well. They do lose a bunch of money in hedging, but still significant upside. And where am I here? So because we already have Q4, I'm not going to put that in there. And we go straight to the 2022, where production growth is actually negative because their production in Q4 was 72,500, and they're projecting 70,500 for 2022. So we have to take that into account. The growth netback 27, I've stolen it from their actual netback in Q4, which was the operating netback. I'll just pull it up so that it's clear for anyone looking at the video here. So 2022 guidance, the netback is about 27-ish is what they're guiding for. And we get a projected FCF yield of 21% after the hedging is taken into account. So it competes pretty similarly with Whitecap. So why do I like Spartan Delta better? Because if you look at their hedging, the hedging is actually coming off after Q2. So after Q2, all their oil hedging ends, and I get full exposure to all the oil price upside with this, which I really love because Montney condensate trades at $2 to $3 above WTI. So I'm getting roughly 93 Canadian, about $115, 93 US, 115 Canadian for this condensate in a growing company, completely unhedged. So compared to Whitecap, which has, you know, some of the lighter oils, which are hedged, I like the inflection point that I see here, that on June 30th, everything goes unhedged. And, you know, that's, if my macro outlook pans out how I think it does, we'll be looking at higher oil pricing by then. And I get this extreme torque to oil and condensate that maybe, I think, you know, this 21 doesn't show you the full picture of what's going on. Are there any questions on Spartan Delta before I kind of share some latest well results and things I'm seeing, and why I like this company in particular, even though it screens pretty, you know, comparably to some of the other ones? So there's a question here on the Black Scholes model for undeveloped reserves. I honestly don't do much work on reserves, very, very little. I look at companies and I say, okay, the 2P reserves, if Meg has 60 years, I'll throw a couple dollars of value in there for that. And every other company in the Canadian oil patch has like 10 to 12 years of 2P reserves. So I don't really take that into account too much. But I'm sure a lot of work can be done on reserves if you think that's what is affecting the share price. I personally don't think it is. You know, there are companies with higher reserves that do trade at premiums, so you can make a case for it. But if you have a ton of reserves and you don't screen well on free cash flow, I'm still not really interested. You know, just the way I run my investments, it has nothing to do with what's right or wrong. It's just my opinion. And you know, there may come a time when 2P reserves will become important in the share pricing, especially if we get to stable, consistent oil price in the 100+ range. I think people will start looking at reserves and which companies can increase production and still have a really good reserve life. But I just don't think we're there yet. What is the value per share after hedging at 80 WTI? So at 80 WTI, there's really not much of a point to invest in Spartan Delta. There's not much upside here. It's the torque that you're playing, and hence why I mentioned the condensate becoming unhedged. It's the price torque that I'm playing here. I really believe oil price can get into these sorts of ranges. And, you know, so at 80, I have about a 10% upside. At 100, I have roughly 150% upside. Whereas, you know, some of these stabler companies, actually Whitecap has a really good upside too at $100 WTI, you know, looking really good, in fact. So, yeah. Even if it's a great market, will the risk to go fully unhedged? We don't know, but even if they hedge today, I think the pricing is fine, and I don't think they're going to hedge too much. This is the latest update. This is February 15th, 4 days ago, and they haven't added any condensate hedges. So it kind of gives you an idea into what management is thinking in a way. So let me share some well results. So this is from Scotiabank. We have the type curves. The red line is kind of the type curve, which is what Scotiabank expected these wells to produce. And look at how the wells are doing. The most recent Velvet wells. So I used to work for Velvet in these exact areas, in the Gold Creek area. Did a bunch of startups and field operating, field engineering. So a little bit more familiar with the asset base, along with the inception stuff as well, from my work in Grand Prairie. And I'm telling you, these wells are sustainable. These are not one-off wells that somehow produced this huge beat on the type curve. This is predictable, sustainable well productivity. This type curve is the one that's going to have to come up. The well results are not the ones that are going to come down. Same with the oil production. We're seeing very solid oil production. and beating the type curve. The Inception wells are closer to Grand Prairie. They're sour wells, not the best land, but it keeps the production going. And the Velvet wells gives it the upside as to where things are going. These are the latest wells. So I don't think Scotiabank even has these on their presentation. This is from Petro Ninja. You know, this is what I call the car area. It's 64.2 W6. This area in the car is very special because this is a well that's about 3 years old, more than 3 years old now, and it's declined roughly 50% for a Montney play. Regular Montney wells decline roughly 70% in 1 year. This well has declined 50% in 3 years. Why is that? It's because this area of the car has a natural fracture where the different layers of the Montney drain into the bottom layer. So if you drill a well in the bottom layer of the Montney, you get declines from the bottom layer, but the top two are naturally flowing into this bottom, giving you this really nice decline curve, you know, and it's not like production suddenly fell off a cliff at any point. It's still leaking into this reservoir. It's giving you exceptional results. So what Velvet did was they drilled 2 more just before they got acquired. And these wells are even better. 6 months down the road, they're producing about 93 cubes, so cubic meters of oil, about 600 barrels, just over 600 barrels. 6 months down the road, these wells, the 3-year-old well was roughly at 70 cubes. This one is at 93, and the 3 of 21 well is about at 100 cubes. So amazing well productivity. These wells are paying out in about 4 to 5 months, and they just continue to generate cash. They don't decline. They make a ton of money. You know, it's looking good for decline rates. It's looking good for cash flow generation. They've made their money back in 4 or 5 months, and then they keep making that much money back. Unlike other wells that pay out, and then they're basically producing so little at that point that it doesn't even matter that the well is really on production. So keep an eye out on this. This is an area that Whitecap, again, has some JV wells with Hammerhead in this area. ARC Resources is very close to this area. Those are kind of the biggest players, I would say, and hence why I like ARC as well. It's another favorite of mine. And this work that Scotiabank did was validated by this Petro Ninja results that I'm seeing. And Jeremy McRae with Raymond James recently put out this paper validating this further. So we see the type curve. The wells are absolutely demolishing the type curve. And the decline rates are just not the same. The wells are flat for much longer. They're producing way more oil, EURs. You know, this is at 65 WTI, $3 AECO. The payout was still less than a year. Now we're at 85 WTI. We're at 425 AECO, and we're using this type curve. So the well payouts, you know, they might even be less than 4 months. It might be like 3 months that these wells are paying out on. So something you really want to keep an eye on here. I'll just go through the comments real quick before I get to the next one. The hedges, not going to hedge. What impact will the TMX cancel? I don't think the TMX is canceled as far as I understand. I still think it goes through. The final levy on it, the pipeline fees might be higher than what people were looking for, but I still think it gets built. I don't see how it can get fully canceled at this point. It's almost a better thing because if you want to look at the oil macro, when does Canadian oil sands come online and be the savior of the world? Well, if they don't have good takeaway capacity, they're going to be a little slow on that. So supply is going to take that much longer to come online. And the Canadian producers already have enough egress. I have an article I put out last week. It's on my website again under articles. on the Canadian egress situation and why people are misinterpreting where we are today. We have 300,000-400,000 of extra takeaway today for Canadian producers. The TMX was going to add another 600,000 on top of that. So the egress issue is not a concern to me by any means at this point. And I would say please have a look at that article. I can explain things much more there than I can on 30 seconds on this video. There's a comment here on Spartan Delta, and I agree. They bought Bellatrix 25,000 BOEs for only $4,000 a BOE. Most companies trade at $30,000 to $40,000 to $50,000 a BOE, so they got a smoking deal here with really good Spirit River and kind of Cardium Peyto-ish gas and acreage, liquids rich as well. So looking quite good. Their assets are fantastic. That's the point I'm trying to make here, that it's important to look at well results and well productivity. You can find gems that the market just does not see. And the things that I'm seeing have now been validated by Scotiabank and Jeremy McRae at RayJ, one of the guys I trust the most with this in-depth well to well comparisons. So looking great. And it brings me back to the land position. Gold Creek is these wells here that are outperforming majorly. Look at the amount of land that Spartan Delta has. Carr is these wells here, these natural fractures. They've got a great little package here. They can drill, I don't know how many more, but quite a few more. And then the Simonette is where they're adding capital for 2022 to find out if this natural fracture maybe extends down here. Maybe they can get this play going and find some awesome wells, because as you see, it's kind of an undrilled acreage. So you can find really good high pressured, overpressured rock here and really grow it out in a short amount of time frame. So yeah, that's that on Spartan Delta and the company valuations. I think I've been talking long enough. I estimate Spartan Delta capital at 6,000. Yeah, looking great. And Michael says it's its largest holding. So great to be right there with you, Michael. Jeremy McRae at Raymond James. Yes, correct. He's the one who comes up with these graphs. I can't share the whole report since it's a confidential thing, but if you reach out to him, he might be able to provide it to you. There's some really good information in there. This is for Scotiabank clients can get this, and Petro Ninja is free. So if you want to know more about Petro Ninja and following these wells, give me a shout. I can run you through this. I like people that actually put in a lot of work into these and bounce ideas off of each other. So if that's something you want to get into and spend a few minutes on, I think it's worth your time on some of these wells, like Spartan Delta, like ARC's latest wells, ARC Resources, Surge Energy with their multi-leg Sparky wells. You can track them month by month, see how they're doing before the market, spends the 5 minutes required to look at what's going on. Some of the Southeast Saskatchewan stuff is on there. So yeah, I'll leave it at that. Yeah, I think that covers the valuation session. We have the same thing 2 weeks from today with no macro. The macro is every month and the company valuations are every 2 weeks. So next week, 2 weeks from today, we have Grand Tierra Energy, Petrotel, and Bonterra coming up. 3 kind of very interesting names that have been brought up to me. And I thank everyone who's joined in and went through this for so long and really stuck out and spent time here, spent your Saturday, your very valuable Saturday out here. I really appreciate your time there. And I guess I'll open it up to questions on the Zoom chat if anyone has questions. And after that, I'll end the Zoom and I'll open it up on Twitter Spaces. Anyone that wants to chime in or say anything, but I think we've been at it for quite a while, so I'll try and wrap it up here. So okay, we have some questions here. Can you comment on Tamarack Valley? So I like Tamarack Valley. I like the play. It's very similar to Surge and Whitecap almost. What I don't like about Tamarack Valley is the acquisitions they made were quite expensive. They were at 3 to 4 times cash flow. Surge's acquisitions were under 2.5 times cash flow. We just saw Whitecap make these recent acquisitions at 2.6 times operating income. I like that. I don't like companies growing at more than 3.5 times cash flow because it's barely accretive. You can say it's accretive by manipulating the numbers in a way, but it's really not accretive. So I can share more on that, but I don't want to be trashing companies either. So I'll leave it at that. Have a closer look at what valuations that the acquisitions are being made at, and have a closer look at the production numbers that they're putting out. When they say that the acquisition they made was X amount of barrels, is that what the asset is actually producing today? Or is that what they think it's going to produce a year from now after they throw millions of dollars into it, right? So keep that in mind with some of these. Headwater is worth a look.
Quick question, Shubham. Which was the analyst that you'd mentioned that your favorite analyst to look at, the material they produce?
Yeah, so that's Michael Tran at RBC. Puts out fantastic stuff, great videos and great macro outlook kind of stuff. It's not as detailed, of course, but it gets the point across as to what he's thinking, and what he's been thinking has been bang on for the last 18 months. So if you're looking for just an overall quick 5 to 10 to 15 minute macro to share with your people, you want them to understand what's going on, that's the video you want to share. Again, Michael Tran at RBC.
You mentioned an analyst that analyzes these energy companies. Is it the same one?
I can't remember now. That analyzes these companies.
No. So the one that so the material you shared, the graphs that were written, you said it was from a report.
Oh, Jeremy McCrae.
Got it.
Raymond James. He puts out really good stuff with analyzing wells and keeping an eye on kind of what's going on directly. So yeah, thanks for that. Headwater is worth a look. I'm open to a conversation on Headwater because I believe the complete opposite. So I would love to touch base there and kind of get your thoughts on that and why, because I see them as they're valued at about $120,000 a flowing barrel, twice anyone else in their peer group, and their wells outside their core area are not panning out. They're not the same Clearwater wells that they have in their core. So I'm curious as to why you think so. One that I'm pretty curious about. Rubellite here. I like Rubellite. They're also in the Clearwater, but I think it's a misleading company. They claim to have a bunch of Martin Hills acreage, and they talk about it a lot. They only have like half a section in there. So again, keep an eye out on the acreages and the well results. Some of these companies are paid to show you the wrong things and misleading things. Not saying that the rest of their Clearwater is not good, but they don't have much in the Martin Hills, as much as their corporate presentation makes it seem they have. Yeah, thanks again. I'm looking forward to Bonterra. Yeah, me too, for sure. There's a question here on Baytex. So I talked about Baytex in my last presentation. I went through the whole valuation, and I shared some well results on their Eagleford. I shared some well results on their East Duvernay, why I think the Baytex has the only good acreage in the East Duvernay. And then I shared some stuff on their Eagleford as well with Marathon, and why I think it's the last best good stuff left there in the Karnes County. So I'm very positive on Baytex. their acreage as well. I think there's some great stuff there, and one to kind of keep an eye on for sure. It's just too big for me, and a lot of hedging to offer the upside that I want. If it had options, I would maybe be look into it. Yeah, thanks, Mark. Appreciate that comment. It means a lot that people are joining in and really paying attention, because it's kind of why I do what I do, and I appreciate the support. Any thoughts on Kalama Energy? I don't know this company. I will check it out. It's listed in Australia. That's probably why I'm not following. I see Jeremy's on the Twitter space, so I'll just throw this out there. His work on Spartan Delta has been absolutely amazing, and then Surge as well. If you get a chance to read these two reports, the one on Spartan Delta and then the one on Surge's multi-leg horizontals in the Sparky, this is excellent information. If you're in these two companies, you want to try and get your hands on these reports. They really break things down as to why I'm invested in these companies, why I like the upside torque here, and why the general investment public is totally missing this. If you don't do the well work, you will miss these catalysts that these two companies have, which are company changing catalysts. They're not just a little thing here or there. It's company changing stuff going on with these two names. Okay, what are the other questions here? Yeah, no, thank you. I appreciate you guys tuning in. Do Surge, do they currently water flood? Yes, they do have some water floods going on in the Sparky. The decline rate's already pretty good, so I'm not too concerned about it. The margins are good. I mean, some of their Sparky wells are paying out in less than 4 months now. The multi-leg horizontals, some of their old Sparky is paying out in less than 6 months. Their Southeast Saskatchewan is paying out in 50 days. That's the latest number that I have. So looking very, very good from their asset standpoint. So the next space coming up is IPCO, which is tomorrow, International Petroleum Corp. I'm still trying to get a hold of Royal Helium. We had something lined up, but it kind of got moved. I have a different helium company on deck who can explain more about the supply-demand dynamics. So I look forward to bringing them on there. Prairie Provident is another one that's going to be on deck. I have Surge Energy. I'm trying to get them lined up. And then we have a private company in the Duvernay that's quite excited for coming online here. Share some thoughts on what's going on there. So we have a lot on deck. I know Sohaib has been working very hard on getting these set up. So I look forward to sharing more when I have something concrete. So Rubellite has higher water saturations with i3 Energy. Bit of an arms race with drilling with Spur. Yeah, so Spur has excellent assets. So you want to look at kind of where Spur is around them is very, very solid stuff there. Yeah, like Spur is possibly the best run company in Canada. So which one, if it had options? I'm talking about Baytex. Baytex is one kind of like Crescent Point, where I just don't think the equity offers me the upside, especially with the hedges, but the options offer incredible torque. Crescent Point is drilling some monsters in the Kaybob Duvernay, so I look forward to sharing more on that here in a Twitter thread shortly. When are you on BNN? I'm open. I don't think I'm there quite yet, but my DMs are always open. So I look forward to any opportunities. I did have an interview I did with Maria Skonieczny on Value Investor. It's about 30 minutes. So it's also on my Twitter thread somewhere, I guess. So I can link that as well. It's a little 30-minute discussion and my little thoughts on Surge and ARC Resources as my top 2 picks on them. Oh, I didn't realize Baytex has options, so I will look into that. Can you please make your case on oil field services? So I would love for oil field services to make a killing of money, even if it's at the expense of my equities. I just don't think they can. There's 18% inflation within service companies internally with labor and steel and whatnot. So for them to pass on 18% plus pass on some sort of increased margin, I think is going to be very hard. The second problem in Canada, there's service companies that are willing to work at losses, and they kind of screw up the entire market. And I know this is still the case today because I keep in touch with my Grand Prairie contacts, and they're telling me it's getting hard to increase rates. Like it's just not easy. So until I see that tonality change, I'm just not really interested in them. You know, some of them didn't even make money in Q3 and Q4 with the prices where they were. So you would have to see a big kind of switch, and I just like the E&Ps better. I think service companies, unfortunately, are going to get thrashed again and taken advantage of until there's some consolidation or there's some other catalyst that comes in. I don't think the E&Ps are going to be happy to pay 40% more for their D&C all of a sudden, you know, because they're already having to beat inflation. And if the service company wants to increase margin, I think they'll get a lot of pushback on that. What are your thoughts with i3? I'm a big fan of i3. You know, full disclosure, I got in at 18.5 cents. So it has been a gem of a play for me. I've done really well. The dividend brings additional shareholders in there. I love their assets. I like their Wapiti Cardium. I like their Simonette play. They just finished drilling a couple wells in the Grand Prairie area with Horizon 43, I believe. So look forward to them coming online. The North Sea farm out is another catalyst. The deep basin stuff they got from Cenovus, I know it has a lot of optimization potential. Cenovus just couldn't give it to the love it required. So they can get really good capital efficiencies and bring on production there. Looking really solid. I'm a big fan of i3. I know some of the guys that work there, the Canadian field operators and the management, the foremen, you know, people who know what they're doing, and they really put the work in. So I'm quite happy with that holding. I still see significant upside there. Used to be 3 months out. I don't know what that's referencing. Maybe the Baytex options. Yeah, I will have a look. Whitecap is going to buy Cardinal.
By the way, Shubham,
yeah,
the Baytex stuff, only 3 months. So unless you're going to make 3 months bets.
Oh, I see. Okay.
Probably, yeah.
Okay, that might be why I haven't looked at it, because I look more in the 6 to 24 month time frame. But I appreciate you sharing that. I did not even know that they had options, or have forgotten that. Yeah, so this Whitecap buying Cardinal, I don't really think it happens. I think Cardinal is just its own standalone entity. But if there is a company that's going to go out and buy these corporations with assets, scattered assets like Journey, Whitecap, or Cardinal, i3, etc. You know, Whitecap is one that does have assets all over the place, just like Tamarack Valley. So I guess we'll see what happens. But I don't think Cardinal gets sold. I think there's just a lot of subjectivity to me saying that I don't really want to get into. Enerplus, I like Enerplus, yeah, but I'm bearish on the Bakken in general. So I don't like to invest in companies that are strictly in the Bakken. And I kind of shared why in my macro outlook. I think there's issues there that are popping up with gas takeaway capacity, with flaring lockdowns, with asset quality in general. Not saying that Enerplus doesn't have good assets. It's just It's just not the kind of runway I need. It's just not a play that I'm interested in. The Bakken is not a play that I would be looking to really go all in on. And I think Enerplus is pretty richly valued for what they are. So it doesn't offer me a deal or anything. But maybe that's what you're looking for, right? So it depends on your investment thesis and your own portfolio kind of objective, what you're looking for. Cool. Well, I don't see any other questions here on the Zoom, so I'm going to end it here. And thank you again for everyone that joined. The recording will be up by, I'm going to try and get it up by tonight, but I'm in the Dominican area. It's 8:15 already, so I'll see how long it takes Zoom to get the recording ready and YouTube to upload it. But should be there shortly. What else? I did have a seminar planned for tomorrow on the options because I got a lot of questions on it, but I'm going to delay that because there's a call at 12 p.m. Mountain. I believe it is with IPC. Is that correct, Sohaib? 12 p.m. Mountain.
Yeah, that's true.
Yeah. So we'll have a chat there.
William. Okay. Cool.
Yeah. We'll have a chat there with William Lundin and get some information on that play. Another play that I really like, and I'm going to cover that 4 weeks from now on a valuation session. So yeah, I think that ends it, and hope to see everyone there tomorrow, and hope everyone has a great rest of the weekend. And thanks again for tuning in.
Just one question before we leave. What do you like about IPC? If you could just mention that real quick.
Sure. So IPC has excellent free cash flow potential. Its free cash flow actually trades at a better screen than even Surge Energy. But IPC, it's just a name that I think will always trade at a higher free cash flow yield, just because there's not enough people that know about the name. Its headquarters are not in Canada, as far as I know. So, it's kind of like a hemisphere play where, yeah, you have the higher free cash flow, but is the market ever going to realize that? And I just don't think so. In a way, the liquidity is just not there for a bigger fund manager to get in. So there's some issues there. There's a question here. Can we see when you're doing spaces or seminars? So if you go to whitetundra.ca, scroll to the bottom, upcoming events, it'll have all the upcoming events I have. I have one on the basins in the US and kind of the pipeline capacity and whatnot coming up to in March. And then I have 2 more of these planned, these company valuations, and I'll keep doing them every 2 weeks. Macros every month. Twitter spaces, they're kind of impromptu, a lot of them, but anything that I am planning, I do share that on Twitter itself. Any comments on ROK acquiring assets? I think it's a great play. I think they'll do well here. They've copied the Saturn oil and gas business model, and they're kind of doing the same thing. They've hedged a bunch of the oil. They bought it at less than 2 times free cash flow, I believe. So, looking pretty strong. I don't have the liquidity to get in the name. I've spoken with Cam there, the CEO, before. We're also trying to get ROK, that's right, on a Twitter Spaces. And I just like it. It's a great thing, but I think it's too early. Like, they're going to keep buying assets. They're going to keep diluting the shareholders. So I see no reason to really buy it right now and get stuck in it. There's other more liquid assets available, companies available. And in terms of acquisitions, there is a ton of private equity backed companies for sale in Canada. Like, almost every single one is for sale. So there is a lot of assets for sale at very good pricing, and companies such as ROK, Rock, are going to go out and maybe acquire some of these. So and they don't have to overpay for them. So depending on how you feel about that, I guess you could look at it. But for me, it's just too much a risk there of shareholder dilution and debt financing and whatnot. So it's not of interest to me specifically. And yeah, my email is always open. My DM is always open. I love chatting with fellow oil and gas investors. I had a chat yesterday for like 2.5 hours with someone from Ontario, and had some more earlier in the week and kind of in the last month that have been just amazing. So feel free to reach out, and we can have a chat and talk more. But yeah, thanks again. I'll stop taking more of your Saturdays, so I'll definitely end it here.